Please remember that share trading, spread betting, and trading CFDs carry significant risks and may not be suitable for all investors. With our mandatory disclaimers out of the way, I'm going to start this presentation with handing it over to Carl and his brief introduction into cryptocurrencies for those of you who are not that deeply involved into the subject. So, Carl, why don't you kick it off?
Okay, thank you, Victor. I thought, given this is our first live webinar on cryptocurrencies, we should start at the start and don't assume that anybody who's joined us is an expert yet, but hopefully we can give them the tools to understand what they're doing better. And if they have already been trading cryptocurrencies already, maybe there's a couple of things in here they haven't learned before. But it will be a brief overview, I promise, 5 slides in total to summarize the whole concept of cryptocurrencies. But I think the best place to start is with what is a blockchain. And a blockchain is not the picture on the screen where we've got some blocks with a chain. It's a term that refers to a database. So it is a digital ledger is another way to explain it. So it's not an old-fashioned ledger that you would have in a book that might record some transactions of a business. It is fully digital. And each block of data, as they are called, are linked or chained together in chronological order. This means you have a complete record from the very beginning until the current time of every transaction that has occurred in terms of what are the applications. It's useful for recording a ledger of transactions, a history of transactions. It is immutable, which means the data is irreversible. One of the practical applications of blockchain technology is a currency like Bitcoin, and we call it a cryptocurrency because it is a digital currency only. You cannot go to an automatic teller machine or a bank and ask the teller to withdraw Bitcoins for you. They have no physical or tangible form. They were created in 2008/2009 by a person. We actually don't know who this person is in real life, but they go by the pseudonym of Satoshi Nakamoto. And his definition for Bitcoin is it was new at the time, electronic cash system that's fully peer-to-peer with no trusted third party. So it's something to give you an idea of really what they're trying to achieve here, which is no intervention by a central authority or by a government. The system itself is run, it's maintained, it's effectively owned by its users. Bitcoin is a unit of currency that uses this blockchain technology. Various nodes, and nodes are simply users. It could be yourself, who has a computer that is trying to solve what is ultimately a very complex cryptographic algorithm, hence the name crypto. So it's a mathematical problem that the computer will attempt to solve, and that obviously uses computing power, which uses electricity. And there's been some talk about Bitcoin's impact on the environment because of all the energy required to maintain the network. Now, each node is trying to solve this algorithm, and when the algorithm is solved, a new block is added to the blockchain, and that contains various information of transactions that have occurred since the last block was effectively mined. So we call it Bitcoin mining. And the node that is lucky enough to have solved that problem first is therefore awarded with 1 Bitcoin. But along the way, miners can also earn transaction fees as they solve these equations. Once you've got your Bitcoin, it is accompanied with a private key that is also held on the ledger that is used to unlock, or spend your Bitcoins with retailers that might be accepting those or change it into other units of exchange like dollars or pounds or whatever you'd like to spend. Originally, there were 21 million Bitcoins created. There can never be more than that. That's simply built into the system. Almost 19 million have already been mined. And of that, about a third of those have been lost. If you lose your key, you effectively lose your Bitcoin forever. There's no way to get your Bitcoin back. And there's stories of people who have lost their keys or can't remember the password to get into their key, and therefore have lost millions of dollars because they can't get to their Bitcoin. And some were actually stolen in a hack a few years ago, and they can't be used anyway because the blockchain, when they pop up on the blockchain, it'll record that they have been stolen, so they'd be in effect useless. So there's actually fewer Bitcoins than you might imagine, and the rest are going to be mined as we go on. So that is Bitcoin. Ultimately, it's a currency that is it is decentralized. This idea of decentralized, it's peer-to-peer. It's not held by the Federal Reserve in the USA, or it means with that fixed supply. One of the problems of what we call fiat currencies is of course that those central banks can issue more currency anytime and therefore devalue that currency. With Bitcoin, that can't happen. But when we get to the practical applications of blockchain, it's not just about having these units of exchange, these currencies. The real reason why you want to use this blockchain technology is because it supports decentralized finance. So finance, we know what that means. Decentralized just means that it's peer-to-peer. It's not held in any central location. And we're using this blockchain technology, this ledger technology, this immutable ledger that we have. It can't be changed by any individual. It's always going to be that way. So you've got that security and confidence in it to facilitate contracts. So it could be a trading contract, whereby two parties agree that a certain instrument will be at a certain price at a certain time. And by using these, what we call smart contracts, they can automatically execute these transactions if certain conditions are met. So if the price is achieved, one party will automatically pay the other party the cryptocurrency involved. There are these other quirky things that have popped up more recently called NFTs. It stands for non-fungible tokens. It's another type of smart contract that relates specifically to a digital item. So you might have heard recently that a digital artist that goes by the name of Beeple, he created this digital artwork that's on screen right now, and it's sold via a non-fungible token for US $70 million, which is quite extraordinary. So it's real, it's happening, the world of decentralized finance. And I guess the currencies, the cryptocurrencies that we like to trade in, hopefully we can make some money doing that. Really, they're there to facilitate this whole new world of finance. You might have also heard of the term of decentralized applications, or DApps, and that it's just much like any application you've got on your cell phone at the moment. It's just a user interface. It facilitates a user interacting with these smart contracts. Which brings us to some of the alternative cryptocurrencies out there. So what are the currencies apart from Bitcoin? Bitcoin certainly gets the most publicity. It's the largest cryptocurrency by market capitalization, but there are many, many others out there and new ones being created each day to solve a problem in finance, typically in digital finance. The second biggest by market capitalization, probably the best known alternative to Bitcoin, is Ethereum. You may have traded that. It's as it says there, number 2 cryptocurrency by market capitalization. But it's more than just a currency. So Bitcoin is really just a unit of exchange. What's unique about it is it uses blockchain technology. Ethereum, on the other hand, is more of a platform. It's more of an ecosystem. It's an environment that supports decentralized finance. It's an environment that allows you via the blockchain to utilize these smart contracts. And the unit of exchange linked to those smart contracts are Ether. So the ticket code there is ETH. So when you're trading Ethereum, you're actually trading this Ether, and you might only ever trade Ether and never bother with using the smart contracts. But the reason why Ether might do well and be more successful than Bitcoin in the long run is that it does support that decentralized finance where Bitcoin does not. So if you're comparing the two and saying, well, which one will still be around in 10 years' time, there's certainly a very strong argument that Ether will still be around in 10 years' time, and maybe Bitcoin might be a thing of the past. And that might sound unusual, but it wasn't that long ago that we were all using Nokia cell phones. Okay, Apple came along with the iPhone in 2007, 2008, I think it was. And how many people listening tonight have a Nokia cell phone? You can get onto the chat feature if you like and tell me if you've still got a Nokia cell phone, but I doubt it. So things can change very quickly, but it's certainly, I think, better placed in the long run than Bitcoin to take advantage of decentralized finance. The other thing I'll say about Ethereum is that it is what we call proof of work platform, which coincidentally is the same methodology Bitcoin uses to verify the blockchain, to verify that ledger. And proof of work, it's a lot to do with that mining. Basically, the calculations are happening all the time, and when you can prove that you've done the work, you're rewarded with the cryptocurrency. The other platform, which is the alternative to proof of work, is called proof of stake. And the newer platforms that are coming on with their own specific currencies. So when you hear of a coin offering, often the coin offering is the coin that's used on this new platform. So the two big ones which are quite interesting in this proof of stake space are Cardano, and the ticker code for that one is ADA, and Polkadot, which has got a ticker code DOT, and they are currently respectively 7th and 8th in terms of market capitalization. Incidentally, and I didn't think I would ever say this, 6th on the list of market capitalizations is Dogecoin right now. We might talk about Dogecoin a little bit later on. But unlike Dogecoin, these two here are the real deal. They are proper decentralized finance platforms using those cryptocurrencies. But they verify the blockchain constantly without the need to mine. Basically, the model randomly chooses a winner to be awarded the new currency based upon the stake. So the more you have, the more likely you are to get this new coin, but the more likely you are to obviously want to keep your computer running to facilitate these transactions as well. So the people that own the currency have a vested interest in maintaining the platform and keeping the currency going. It tends to be less energy intensive than the proof of work model, because in the proof of work model, all nodes are solving the same equation at the same time. And that is quite wasteful. And that's, I think, another big problem for Bitcoin going forward. I mentioned, will Bitcoin still be around in 10 years? This is one of the things which could negatively impact on that scenario, but also it's negatively impacting potentially on Ethereum as well. So I like to look at some of these newer coins that use proof of stake. It also allows for lower transaction fees on the network. Ethereum and Bitcoin transaction fees are quite high compared to Cardano and Polkadot. Transactions occur much faster, and the platform more generally is quite scalable as well. So that is our 5-slide introduction crash course to cryptocurrencies, Victor. And I thought I'd just finish off by just showing some of the charts of the currencies we've been talking about at the moment. Look, only going back about 6 months, because before that they were very, very flat since 2017. But we can see obviously the growth in Bitcoin from around about that 15,000 level to topping out at about 64,000. It's pulled back to about 55. Over that same time, the next one is Ethereum, which has actually in percentage terms done quite well also, moving from around 500 to about 2,500. So that's, 500% increase. And whereas it's about 400% increase for Bitcoin. But again, we're starting to see the outperformance of the Ethereum network compared to the Bitcoin, really just cryptocurrency. So the ability to do smart contracts. And then the up and comers, for example, we've got Cardano, which has gone up 15 times over that same time frame. And then the next one there is Polkadot, of course, which has had a similar sort of move. In terms of where the charts are at the moment, they're looking quite constructive, I think. The trends are still certainly skewed towards the upside for all of those key currencies. Yes, there's volatility in there, but that is part and parcel with cryptocurrency investing. I don't think you'll be able to get away from that for a very long time. This is the Dogecoin we talked about, which I won't spend too much time on it, but it was basically a meme coin or a joke coin that was created. You might be wondering, where does Dogecoin sit amongst some of the ones we've talked about? It is obviously a cryptocurrency. It does use blockchain technology. It has been linked to the Ethereum network. So in theory, it can do smart contracts. That is actually possible. I can't tell you if it's proof of work or proof of stake, and you probably couldn't even find out even if you wanted to, but maybe somebody can inform me on that. But I think the problem with Dogecoin is its acceptance by day-to-day businesses. So for example, you can go and buy a Tesla now if you wish using Bitcoin, but you can, as much as Elon Musk has touted Dogecoin in his tweets, you certainly couldn't buy a Tesla with Dogecoin just yet. So it's interesting to see what will happen with this one. As I said before, it's moved up past real world plays like Cardano and Polkadot into 6th place by market capitalization. I would suggest that's probably not sustainable, but hey, crazier things have happened, and crazy things do happen in the crypto space. Over to you, Victor.
Yes, indeed. I was just looking yesterday that Dogecoin surpassed the market capitalization of Ford of the Ford Motor Company, which is quite insane if you ask me. But more on the value of cryptocurrencies later. We're going to focus now some attention on to the recent IPO of Coinbase, which has been a very hot topic for some of the market participants. So let me just change the slides. So Coinbase got listed last week, and as you can see, it's kind of a promising company from revenue point of view. You can observe on this slide that throughout the years, its revenue between it took 5 years for the company to basically multiply its revenue stream dramatically, starting from 16 million of revenue in 2016, moving to 927 million in 2017 when we saw this crypto boom and the topping out of cryptocurrencies, which impacted the revenue streams for 2018 and 2019, where we saw significant decline due to the decline in the value of cryptocurrencies and consequently the interest on part of traders to invest in cryptocurrencies. But last year we saw a rebound, a massive rebound of driving the revenues of Coinbase to over $1 billion, and only in the first quarter of 2021 the revenues of Coinbase have almost reached $2 billion. So that alone tells you how much has the interest on part of the public increased in investing in cryptocurrencies, and this serves as a very significant testament to the potential of cryptocurrencies going forward. So sorry, the profit numbers are a bit different for Coinbase, but nevertheless the trend is the same. We saw 380 million profits in 2017, some losses in 2018 and 2019, and back to the green in 2020, and another boom in the first quarter of 2021, where the revenues of where the profits of Coinbase have reached 765 million on 1.8 billion of revenues, which is a very lucrative business. So the IPO itself didn't go that well. Mostly, we'll speak why in a minute, but mostly we have to take into account that the initial trading price was quite high, and there's been a lot of insiders that have been cashing out. I will show you what drives me to this conclusion on the next slide. So basically, as of April 12th, 2021, there were 130 million shares of Class A common stock. This is the stock that is actually listed on the exchange and which can be transacted, and 68.5 million shares of Class B common stock. This was announced in a PR by the company, and basically these figures were outlined just before the IPO. However, according to the securities registration statement from about a month ago, they were 164.5 million Class B shares. So what happened is that these Class B shares have been moved, have been swapped for Class A common stock, so that the early investors could cash out when the IPO happened. Otherwise, they wouldn't be able to sell these shares on the market. So I think that there's still enough supply out there. We haven't seen yet the official disclosures of how many shares different investors sold, but those are going to come, and this is going to have an impact on the IPO. I think that one of the key factors to watch is the price of Bitcoin here, and potential a potential breakdown could indeed be something to look at. And while, as Carl mentioned, for now things look constructive, there is a risk, a key risk for cryptocurrencies and for Coinbase. Consequently, the price of Bitcoin needs to kind of hold in this at these crucial levels. In my opinion, it's the area between 50 and 55,000. We have seen a relentless uptrend since last summer, when Bitcoin was trading circa $10,000. It basically grew 6 times, as already mentioned by Carl, and we have seen some key technical levels being reached in recent sessions. So I'm going to highlight the 50-day moving average, which has in the past served as a pretty solid support. We have tested the 50-day moving average on Sunday of all days, and so far we have had a couple of closes below it. So if Bitcoin doesn't rebound in the coming sessions back above this 50-day moving average, we could see another leg lower, which of course is can be quite worrying for crypto investors and for prospective investors in Coinbase. So what I'm going to do is continue with the next slide. So here are the threats to Coinbase's valuation, which are regulation, crypto prices, and competition on part of other exchanges which are not publicly listed yet. And the top positives, which are crypto prices, lack of regulation, and the competition that so far is being blown out of the water by Coinbase being the first company to get listed, the first exchange. So let's circle back to the main reasons for the drop which we observed on Friday. On Sunday. The drop was triggered by some speculation that the U.S. Treasury is looking into illicit activities using cryptocurrencies. So basically, this was the official sort of trigger for the decline. At the same time, we saw a tweet coming online, which basically highlighted this news item that the U.S. Treasury is looking into it. Coordinated a couple of articles from Bloomberg said that Janet Yellen is this is the U.S. Treasury Secretary that she's looking into cryptocurrencies and worried about some recent developments, and it's only a matter of time before governments pay more attention to this. And some people argue that once this industry is regulated, it's going to lose its competitive advantage. What do you think about that, Carl? Do you think that there is scope for such speculation?
Well, actually, another thing that occurred, Victor, on a Friday evening was the Turkish Central Bank.
The hash rate?
Yeah, well, the hash rate happened on Sunday, so that that coincided more with, I think, the flash crash in the Bitcoin price. But on Friday, so it was a combination of factors. On Friday, the Turkish Central Bank banned all payments in cryptocurrencies from the end of the month. So it's there's been speculation. So if you look at the dips on the screen, so there's a dip there sort of mid-March, and Bitcoin, funnily enough, is always looking fantastic just before these sort of news breaks. So right there was a rumor that India was on the verge of passing. So is some legislation sort of, it's been written. I don't think it's in Parliament yet, but there are proponents of legislation to ban cryptocurrency in India. That was that dip. But the Turkey's actually done it. And then the dip before that, if you look at in late February, there's a big dip there. That was Janet Yellen actually making some comments that,
this one?
Yes, that was Janet Yellen making some comments that cryptocurrency would need to be regulated. So each time Bitcoin's looking very good, coincidentally something occurs, unfortunately for Bitcoin believers, to knock it back down again. And then we also had the blackout in northwestern China, which that really, I think, was the trigger for that flash crash. Because if you look at the hash rate fell by 45% in the matter of a few hours, and Bitcoin obviously fell as well. So, anytime you have an asset which is so vulnerable to something as simple as the power going out in a particular country, and China accounts for roughly half of all Bitcoin mining at the moment, and that province is about 2/3 of that. So it just undermines the confidence, I think, in a particular asset. But it also highlights, I guess, some of the benefits of some of the proof of stake ones, which are less energy intensive, maybe less controlled by Chinese mining pools. Bitcoin's a very interesting,
right. So much for decentralization.
Perhaps.
If everything is focused on this region in China,
it's quite centralized, isn't it? I said earlier that Bitcoin might not be the cryptocurrency of the future. It's certainly the one that has given this area great publicity. But my own personal belief is that it may not even be around in 10 years' time, and some people may scoff at that. But I don't think it's the one that will eventually be widely adopted.
Yeah. So to sum up, for those of you who are looking for an answer to the question whether they should invest in Coinbase, we don't have it. However, you should treat Coinbase as a regulated proxy for the performance of cryptocurrencies. So it might not be a bad long-term investment if cryptocurrencies stick around. This is you're much safer. Like if safety is your concern, it's probably much safer to own Coinbase stock rather than just go ahead and buy a cryptocurrency, because, as Carl just outlined, you might not pick the winner out there, and it's very difficult to know which one it will be. So Coinbase is exposed to all of them, and as such, as a regulated company, as a company with a very high operational margins, as we saw in the slides that we discussed earlier, it's basically a way for you to bet on cryptocurrencies without owning a cryptocurrency.
Yeah, I think that's a good point, because if you look at the revenue and the way it's changed, it's basically based around volatility in the crypto market more broadly. So it doesn't always rely on a particular currency going up. Hey, if the currency goes up or down, as long as there's volatility, people will trade and then they'll earn their commission. So I think that what you say about it being a model that benefits if cryptos do well in general, I think that's correct. And then if some cryptos don't do so well, that could also benefit them as well, just from the volatility and the trading it creates.
Okay, so guys, if you have any questions which you are willing us to discuss, feel free to ask them right about now, because our time has just ended for this webinar. Thank you very much for attending. Thank you, Carl, for taking the time to join us and discuss some of the latest developments on the cryptocurrency market. We certainly going to revisit this topic probably into the first earnings call from Coinbase. So until then, with that, I'm closing this webinar. Thank you for attending. Looking forward to seeing you next time.
Thanks, Victor. Thanks, everyone. Bye-bye.
Cheers. Bye-bye.